Hello and welcome to Weekend Investing Daily Bytes. We had a small break from daily episodes and now we're back. So we're shooting episode 253. Today is 4th of July, Independence Day for the US. Markets are closed there. We are going to look at the sovereign gold bonds and what are the yields that are available there. We are also going to discuss a very interesting tool made by Mr. Amit Wani, which you can use to analyze sovereign gold bonds, and several queries came to me for this, so I am using this opportunity to explain that. In terms of the market was dull in the first half of the day, with IT, commodities and metals taking a beating. In the second half, the markets recovered and FMCG led the rally. ITC in fact led the rally within the FMCG pack, 2.5% up on FMCGs. PSU banks and some consumption stories also perked up. IT, metals and commodities, as I said, were the weakest link in the market today. So not a very decisive day. We are still, after this fall couple of weeks back, we have been sort of being range bound below 16,000 and not really going back up as yet. So maybe there is more time to be spent here, maybe there is more fall to come through. I'm not sure. We are pretty much following global cues on this. The domestic situation remains the same. Domestic buyers are buying, foreign institutional sellers are selling. That equation has not changed. So we are waiting for cues. I think the biggest cues now will come from the quarterly results. If the results are extremely surprising on the upside, we will definitely see an upside. But if there is any kind of a disappointment, I think we will see a good downside if that comes through. So I'm hoping that results will come in line or at least better than what we expect. So as I said, a mild day, about 0.5% up on every index except Nifty Next 50, which was up 1%. Nifty was up 0.5%. Small caps were up also 0.5%. Within the weekend investing strategies, NNF 10 was up 0.7%. A lot of other strategies were up 0.5%, some 0.25%, and MI all cap was down minus 0.3%. Some of the oil companies have been brutally beaten in the last few sessions, and Reliance along with ONGC, oil, MRPL, some of them have really taken a beating, and that may have been the reason for a fall in some strategies. Like you can see here in the heat map, ONGC is down 4% today, and steel and metal space along with commodity space also collapsing. Tata Steel down 2%, JSW Steel down 4.75%. Of course, there was an ex-dividend also here. But FMCG really shining through, as Hindustan Lever up 4%, ITC up 2.5%, Britannia up 3.2%, Nestle up 1%, and some consumption stocks also up. IT stocks beaten, minus 2.4% on TCS, Infosys still stable, banking stocks slightly in the green, some of them doing better than others, State Bank and ICICI Bank in particular, and some recovery in some power stocks also. Power Grid was up, NTPC was up, and so on and so forth. So not a very decisive day either way. Dilip Buildcoin was a top gainer, plus almost 10%. AIA Engineering up 7%. Linde India, Central Bank, Jubilant, all up about 6 to 7% in the top gainers in CNX 500. Within the top losers, you had HLE Glasscoat, Oil India, Aptus, Dhani Services and JSW Steel all falling between 5 and 6%. So equal number of sellers here, selling here as well. So this was the tool that I was talking about, SGB Analyzer. This is not made by me. This is made by Mr. Amit Wani. And this is the sort of link. Let me just take you to the tool. So if you and the link is there in the description below also. So he has listed all the sovereign gold bonds here, which are available for trading in the secondary market. Each of these bonds has a issue price at, when it was issued, when they will mature, how many years to maturity, what was the interest rate on the issue price when it started. So this is paid twice in a year. So half of it is paid every 6 months. Then he's calculated the present value of future interest payments. What is the fair value? So fair value is calculated based on the present value of future payments and taking into account the current value of gold, where it should have been today if it was valued fairly in the market. So it should have, so for instance, SGB March 24 should have been at 53.83, whereas it is available at 51.60. So the discount to fair value is 4%. The discount to gold price. So gold price is being fetched from IBJA, Indian Bullion Jewelers Association, and that is about 51.90 or 52 something today. So there is discount to gold price is coming here, and total yield to maturity is essentially what is the total yield based on today's price. So while 2.75% is the sort of yield on the issue price to begin with, but what you can see now is that what is the yield on the current price, so that you can get you can make out and you can sort based on that to find where the maximum yield to maturity is available. And there are FAQs that Mr. Vani has provided here. You can read more about the tool here. I will not go very much into detail. Gold is, prices are fetched from IBJA rates, as I said, and you can also toggle for just liquid, very liquid SGBs where the most volume is happening, and you can see that there is significant, at least for retail usage, there is significant volume. If you want to buy a few lakhs worth or sell a few lakhs worth, that's always possible. Yes, I mean, if you want to buy 5 crores worth of SGB, it may take time, but for normal retail use, I think this is quite good. So what you can do is, if you are a long-term holder, and I would suggest that you do this only if you are willing to hold to maturity. So for instance, the maximum discount to fair value will be there on the farthest maturity SGB. So March 30, the unit that is expiring in March 30 has the most discount, and if you're willing to hold till March 30, you will get a risk-free return of the gold return, and you'll only pay for the interest that you get twice a year. That will be taxable. So from that perspective, you have to see what kind of holding you want to do. Suppose you don't want to go that far, and you want to sort of redeem in a couple of years, so you can look for strategies that or SGBs that are going to mature. So this one, for instance, is going to mature in August 24, so about 2 years later, and you're getting about 4% discount to fair value. So as you get closer to maturity, that discount will reduce. So the farther out you go, the discount will be higher. So market will, the sort of you can say mispricing will reduce as you come nearer to maturity, and so that's the sort of give and take that will be there. If you want to have more discount, then your maturity is much farther away. So the least discount, in fact there is a negative, it's trading above fair value, is SGB 25, and there can be sort of variation in all this, but on an average you are seeing that the next couple of years you're getting about 4% discount to fair value and a couple of percent discount to gold price. So in my sense, long-term CAGR for gold has been 11.5%. If you see last 20, 30, 40, 50 years, there is no reason to think that it will be very different over the very long term in the future also. So if I were to assume that I can get 11.5% long-term CAGR, and in SGBs that is capital gains tax-free, whether you buy in primary or you buy from the market and hold to maturity, you will get the income tax-free benefit if you're buying this in an individual account. So 11.5% if you're able to get tax-free, and another 2-3% or whatever is the yield for your current purchase, if you are able to get taxable, and assuming 30% tax roughly, if you are able to get 2% more on that on a post-tax basis, so 13.5% or somewhere around that if you're getting post-tax, and that is equivalent to about 20% pre-tax returns on any sort of full tax activity. So 20% returns is a very, very healthy pre-tax returns for any asset class, and this is especially because it is a hedge and it's a inflation sort of a hedge, as well as a hedge for hedge against your equity market, hedge against your own currency risk, so on and so forth. So several benefits that gold has always had, that combined with the fantastic, in my opinion, it's a fantastic return. Whether we get it or not in the next many years is of course subject to market risk. So from that perspective, these are fantastic bonds. There is no reason for, in fact, I believe that the government probably is just throwing away money by offering these bonds, because why should the Indian government offer bonds in return for 12, 13, 14% of cost of capital to them? But to their wisdom and to our luck, we have these instruments available. Make the best use of them while they are available. I will not be surprised if tomorrow they come out and say that we will not have any more issuance of SGB, because in my view, that's my personal view, it has not helped in curbing any imports. It has not helped in curbing any gold demand of physical. So the government is basically offering an instrument which is costing them 14%. So why should they do that? It's beyond my understanding. Anyhow, coming back to the presentation. So that was the sovereign gold bond topic, and thanks once again to Mr. Amit Wani for offering this free tool to all the users. I think he's done a great job. We must appreciate his efforts and generosity to offer this as a tool for everybody. Another insight today was about the German trade balance. This was just something that came up and I thought was important to. So you can see that there are only very few countries which are trade surplus. So which essentially export more amount of goods and services than they import. So they have a trade surplus, and Japan, China and few other countries have that, and Russia also has that now. So Germany, which has always been a trade surplus country for the last 3 decades, is now looking at a trade balance going negative, and that is very surprising. I mean, Germany is the sort of European leader in terms of trade, and if Germany is going to go into a trade deficit, what happens to the weaker countries in the European zone? And this is primarily probably due to the enhanced energy imports, gas imports that they're getting from Russia, etc., and many other implications of demand collapse in several of their industries due to the paucity of energy, lower energy costs. So these are large macro events which are happening in front of us, which are once in a lifetime sort of events that are happening. I don't know what is the implication eventually. How much longer can the world keep increasing the interest rates, although they've just started. In the 70s, the interest rates in UK, Germany used to be in 15%, 20%, 25% kind of range to curb inflation. We are just at a start of single digits. So it's very difficult to imagine where we could go if we go that way. But I don't think we can go that way, because much before even reaching 5%, I think there'll be crazy recession, because everybody is up to their neck in terms of debt, and that will become the major issue, not the inflation. So we'll see what happens there. Another insight was from our NNF product. We essentially did a test on which stocks did the best in each year, and no surprises, in the last many years Adani stocks have done the best in this portfolio. So last year in 2021 there was a 278% return on Adani Transmission, and currently also it is leading at around 40%. So the insight here is that all these strategies, which basically stay with the strongest stocks based on the price behavior, are able to take that bias out. We've been sitting with this bias against a particular group or against a particular company because the narrative is such. But what has this strategy done? It has just gone and bought those stocks and redistributed those profits every month. So what NNF 10 does, it allocates to 10 stocks at 10% every month, and then at the end of the month it redistributes all the profits and losses accumulated over that month. So while the accumulation keeps on going on particular stocks, like for Adani Transmission for instance 278%, but it is also keep on getting redistributed, so the risk on any particular stock does not go up beyond 10%. That's the sort of the strategy that we are using here in NF10, one of our most popular strategies actually, and given very decent returns, stable decent returns. So this is something that you can look at to add to your existing strategy bouquet if you don't have it. I have given the descriptions in the links to these strategies and to the analyzer in the description below. I hope you will make use of them. Please do share this with your friends and family. Please do give us a like if you do like this channel, and of course if you haven't subscribed so far, please do so too. I'm happy to be back with these daily bites. I'm sure some of you had written to me that you were missing the daily bites, and it has become a routine for you, as it is for me, and I sort of look forward to doing this every day. Thanks. Bye.